So I think we can start. It's 3 p.m., the usual starting time of these webinars. I'm very happy that we have a special guest today, Leonardo Gambacorta, who studied in University of Warwick and then in Pavia, where he obtained a PhD. Then he worked for several years at the Bank of Italy. He moved then to the BIS, where he was manager in various units, including head of the monetary policy, and then now he is head of a newly created unit called Innovation and Digital Economy Research. He's conducting innovative research in various fields of finance and monetary policy and central banking. And Leonardo also published in the best, in top tier academic journals in finance. So we are very lucky to have an expert both in the practice and in the research activities. And now, before leaving the floor to Leonardo, maybe Alex would like to say something.
Yes, so hello also from my side again, a couple of administrative comments. So here you see again the schedule for this week. So today we are here having Leonardo as a guest, and tomorrow will be the final talk by Paul Ibert from the European Central Bank. Leonardo will take questions related to understanding and the slides during the talk. So feel free to use the Q&A function or feature as every day and post your questions. I will have a look and hand the questions over to Leonardo. And the bigger questions that require some more discussion will be handled towards the end of the lecture. Okay, and with that, I will stop sharing my screen and hand over to Leonardo.
So thank you very much, Alex and Angelo, for the presentation. Let me just enlarge the screen if I may. Is it now more visible?
Yes, perfect.
Okay. So thank you very much for the presentation and for having me today. And it's a great pleasure for me to take part to this set of lecture on systemic risk. So this lecture today is about FinTech, Big Tech, and financial stability. So we are seeing a transformation in financial markets that is taking place around the world, and the FinTech and Big Tech companies are venturing into finance, and these we see determines opportunities and risk. So we have the provision of new financial services for households and firms, but also a new form of risk that I would say are not fully investigated so far and understood. So I will try to show with you some preliminary research that could shed some light on this. So my talk today will focus on to give you a few insights on how FinTech is developing together with Big Tech, what are the implications for credit provision, and what are the new trade-offs between the policy objective that this digital innovation imply. So let me just show you the roadmap for today. My lecture is composed of 4 parts. I start with some groundwork on FinTech and Big Tech credit and some selected trends in these markets. In this part, I will focus on what are the determinants of FinTech and Big Tech credit and how these are affected by country-specific institutional characteristics. In the second part, I will talk to you on how the use of machine learning and non-traditional data are used for credit scoring. Here, I will divide my discussion between FinTech and Big Tech because these bring different opportunities and risk. In the third part, I will elaborate how the new financial intermediation process based on the data reduces the need for collateral, and we'll see that this has implications for the procyclicality of credit and for the monetary transmission mechanism more at large. And in the last part, I will discuss how public policy should adapt to the entry of FinTech and Big Tech into finance. discussing the new trade-off between three objectives that are financial stability, competition, and privacy. So this slide also reports the main source for my talk. So just in case you're interested in getting more information on each point, you can refer to this paper. Okay, let me start with the first part on FinTech and Big Tech credit, selected trends and main drivers. So first of all, I would like to explain you a few terms. What is FinTech? What is FinTech credit? And what is Big Tech credit? So here on the left, I report the official definition of FinTech used by the Financial Stability Board. So FinTech is technology-enabled innovation in financial services that could result in new business model, application, processes, or products. We are all well aware of what FinTech looks like in practice. Think of all the mobile payment innovation that have emerged in recent years, but also the new application for credit, wealth management, and insurance. So let's move to FinTech credit in the middle of the slide. So FinTech credit is a credit activity facilitated by electronic online platforms that are not operated by commercial banks. So this includes the peer-to-peer or P2P lending, so-called marketplace lending, and invoice trading. So there are some well-known examples of this platform in countries around the world, and I show some of them also in this slide. For instance, there is a Zopa and Funding Circle in the United Kingdom, Lending Club and Sophie in the United States, but there is also Iren Digital, Lufax, and many others in China, Mintos and others in the European Union, and Harmony and others in Australia and New Zealand. So finally, the definition of big techs on the right-hand side of the slide. So the term big tech refers to large companies whose primary activity is digital services rather than financial services. So this distinction is very important. So tech companies with large networks and a broad range of activities have access to a lot of data on their users. And they use this data to know better their clients and offer them new products and also financial services, including credit. So also here I report some examples. So in China, there is Alibaba's group and Tencent WeBank. Internationally, there are big tech players like Amazon in the United States and in many countries. Rakuten and others in Japan, Kakao Bank and K-Bank in Korea, Grab and Gojek in Southeast Asia, M-Pesa, Airtel and MTN in Africa, Mercado Libre in Latin America. So this is just to set the stage and to show you the difference among these three terms. An important fact to notice is that financial services are a small part of the big tech business. So the limitation of big tech on the funding side reflect the fact that at the moment, financial services are only a small portion of big tech activities. So we have in mind that big tech are huge in terms of market capitalization. But in reality, their total assets are pretty small compared to a bank, because a bank has a lot of deposits, and the big tech, they have a lot of liquidity, but they don't have a lot of funding. So this reflects on the size of financial services they can provide, and this is indicated in the left-hand graph of this slide, where only 11% of big tech revenues come from financial services. Big tech core business line are in information technology and consulting. For example, they're very active in cloud computing and data analytics, that together they account for around 46 of big tech revenues. On the other end of the slide, you can see the regional distribution of big tech subsidiaries. While big tech serve users globally, the operations are mainly located in North America and in Asia Pacific. So it is interesting to verify the relative importance of big tech credit and fintech credit across the globe. So let's start to do this. So these two graphs report the aggregate figures at the global level. So FinTech, that is a platform credit, is reported in red, while Big Tech, that is the credit developed on the e-commerce platform, is indicated in blue. So based on the data that we have collected here at the BIS together with the Cambridge Center for Alternative Finance, we can see that Big Tech credit is really booming, and this is represented by the blue bar on the left. We estimate that Big Tech lending flows reached 572 billion US dollar in 2019, and FinTech credit is represented here by the red bar, was about 223 billion of US dollar in 2019. FinTech credit flows have actually declined in the past couple of years, but this is driven mainly by developments in China. And I will get back to this in a moment. On the right-hand side of the slide, you can see that these alternative forms of lending are becoming a significant portion of total credit in a few economies. In China, is around 2% of total credit, but is booming. So
Leonardo,
the left hand,
just a quick
yes.
question about those are typically shorter maturities. Or?
Yes, but they tend to increase the maturity in the last year. So typically, for example, in China, they are 3, 6, 1 year. But for example, in the FinTech platform, the average maturities has increased, and nowadays it also goes beyond 1 year. I'll show you some figures, but you can in first approximation you can consider this as let's say typically 1 year or less of 1 year credit lines or loan with a maturity of less than 1 year. Okay, so the left-hand graph in this slide shows that what was in reality anticipating, that the FinTech credit is really declining in China. You can see this here, the negative line, while it is growing quite rapidly in a number of jurisdictions. For instance, in Europe, FinTech is booming, and in particular in the Netherlands, Germany, France, and Italy, but also in Australia and New Zealand. In many countries that are not reported in this graph, FinTech is also booming, namely in Brazil, Indonesia, Japan, Korea. In these countries, FinTech credit volumes have now passed the $1 billion US per year. From the right-hand graph, you can see that for Big Tech credit, the largest market by far is China, but there are substantial large Big Tech lending activities in Japan, Korea, the United States, and a number of emerging market developing economies. In some places like Kenya, for example, Indonesia, these activities are becoming economically very, very relevant. So FinTech credit in China is a bit of a unique case that deserves a particular attention. So the left-hand panel reports the number of FinTech credit platforms in China. From the black line, you can see that there were a lot of platform entries in 2014 and 2016 in a very favorable regulatory environment. Then there was a regulatory change in 2017 that we'll see this change in another slide. And since then, there have been a new regulatory measure to limit the riskiness of FinTech credit that has caused a lot of platform exits. As such, we see that both the stock and flow of FinTech loan is declining in China. On the other hand, we can observe from the yellow line, that is what also was saying to Angelo, that FinTech loans in the last year have a longer average maturity. It more than doubled from 6 to 15 months. So this is FinTech credit, while Big Tech credit is typically, as I said, less than 1 year, or at maximum 18 months. So let me go quick on this slide. As mentioned before, there are important differences between FinTech and Big Tech credit. One is that Big Tech firms are highly profitable, while FinTech platforms have often struggled in the last years. You can see this both in terms of return, it is the average interest rate and net profit margin year. So the average interest rate has declined year, and has been accompanied by net losses for FinTech. FinTech has become not so profitable, but here you can see the net profit margin between the FinTech has been negative, because this FinTech they use as a strategy, the strategy of expand their business, using the retained profits. And while the Big Tech firms are more profitable than FinTech platform, because they have a lot of activities. They don't have only activities in financial services, but as we have seen, they have a lot of activities, and financial services is only a small portion, 10%, around 10%. So based on the existing literature, FinTech and Big Tech credit are driven by supply and demand factors. In particular, FinTech and Big Tech credit are higher where there is, let's say, an undermet credit demand, and where there is it is more attractive for the new intermediaries to offer credit. So this is supply factors. Let's start on the demand side. On the demand side, we expect FinTech and Big Tech credit market to be deeper where there is a higher income per capita, a measure of economic development. More developed markets have firms and consumers who demand more credit. Moreover, we expect that when the banking sector margins are very high, this is measured by the Lerner index, and there is a lack of competition, there is more room for FinTech and Big Tech credit to enter the market and develop. And finally, demand should be higher where existing banking coverage is lower. For instance, where there are fewer bank branches per number of owners. We can also consider, of course, the supply side drivers are very important. Of course, a key driver is access to big data by FinTech and Big Tech lenders. This is a key input into their business model. They may also have a technological advance and advantage in processing this data thanks to artificial intelligence and machine learning algorithms. At the country level, the regulatory stance likely plays an important role. Finally, there is a broad range of institutional characteristics that should matter, such as the ease of doing business, disclosure rules, investor protection, and the development of financial markets.
Leonardo, can I ask a quick question?
Yes, please.
How does the Big Tech and FinTech credit, how does it differ when it comes to the type of the credit loan? So what kind of credit types have you included? I guess credit cards, maybe overdrafts, and these kind of things. How does it differ?
So the typical Big Tech credit is a short-term loan that is given to a consumer or a small and medium enterprise that is based on the history of and the data collected by the Big Tech on the e-commerce platform or other form of network. So in this case, it is the Big Tech that analyze and does the screening of the client and offer a credit. So for example, in China, vendors that are on the Taobao platform, they give via the platform to the Ant group a lot of data via payments, the network score, and so on. Ant group can process. We'll see how they do the credit scoring, and then they offer a credit to the vendor. And as the vendor is typically small, it is of a small loan, a few $1,000s, for example, in terms of value. And then the vendor can accept or not. If they want to expand, they basically accept the credit. So it is really supply driven through the data. the FinTech is a matching into a platform. You have a peer-to-peer that match the lender and the borrower. So, and you know, on the side of the platform, there could be, you know, a small investor, or could be also, you know, a bank. And on the other side, there is the borrower, and the platform simply facilitates the matching, you know. And sometimes there is a credit scoring service, but it is a different model. There is not a lot of machine learning and big data in the FinTech credit. So it's a completely different form of credit to some extent, but it's always developed through platforms. So let me just summarize the results of what are the main drivers of FinTech, Big Tech credit, because they share this idea of to be technologically high developed, and to be different from bank credit, and to also be inclusive in the sense that they can be helpful to provide financial services to firms and the consumers that are in some cases unbanked. And it is interesting to understand what are the drivers, and of course you have to consider this as the drivers in a regression that we ran a regression with all these characteristics together. So first, it seems that both FinTech and Big Tech credit increase with a higher level of GDP per capita, but a declining rate. So this effect is larger for FinTech credit, and the relationship is positive up to a level of around $52,000 per capita. So in most of the countries are still on the left side. So there is still room to increase with respect to the correlation with the GDP per capita. Second, both FinTech and Big Tech credit are higher where there are higher banking sector markups as measured by the Lerner index. And these, as in other studies, could reflect a larger development of alternative form of credit where there is a lower competition and higher cost in the credit market. So when the margin is very high, there is a possibility for the FinTech and the Big Tech to enter and to compete strongly with banks, because due to their market power, the bank, they have a very high markup. Third, the development of alternative form of finance is negatively correlated with the intensity of the bank branch network. This is consistent with the view that FinTech credit serves clients in underbanked areas, and therefore the credit supply is complementary to traditional bank credit. And third, we have also considered how country-specific characteristics could impact on alternative forms of credit. What we have done here is to look at a broad range of country-specific factors. So first, we found that this total alternative forms of credit, is FinTech and Big Tech, is positively correlated with all the indicators that measure the ease to start a new business. We find more FinTech and Big Tech credit in countries where, for firms, it is easy to start a new activity. You know? So second, we find that countries with the more disclosure and the strong judicial system have more developed FinTech and Big Tech credit. Third, we find a strong correlation with the various measures of financial market development. This again underlines the complementarity with the other forms of finance. So fourth is regulation. So this is very interesting. A less stringent banking regulation is significantly linked to more Big Tech and FinTech credit activity. So interestingly, if we look deeper into this, banking regulation explains around 10% of the variability of total alternative credit per capita in the baseline model, and contributes to more than 1/5 of the R square. So it's 20% of the R square is explained by regulation. So this could suggest that the regulation of alternative forms of credit in general is more liberal in jurisdiction where banking regulation is more liberal. So in any case, this result is not consistent with the regulatory arbitrage being a key driver, as at least in the aggregate across the countries that we are considering. So what would think that FinTech and Big Tech would be higher when the banking regulation is very strict on banks, no? But this is not the case. And we think that there is a correlation between the characteristic of the regulation of banks and the characteristic of the regulation on these alternative forms of finance. So, and this calls for the need to have a very soft regulation, at least at the beginning, and to favor the development of new form of credit. So one, it is very important to analyze, for example, the impact of regulation more in details on using the sandboxes. Leonardo? And in general, yes?
Before you move on, there's one question about the former slide, about this bullet point with the GDP. And the question is, what's the rationale behind this correlation with the GDP? And Bastian writes here, my assumption would be that the less developed the country and therefore the less financial infrastructure available, the higher the importance and effectiveness of fintech companies.
Well, it depends. So here this capture demand. So of course, if GDP reflects the activity, if there is higher activity, then there is more demand for credit. Of course, this could also capture, if you don't include other variable, other could correlate with the idea of this question. So one could have in mind, well, is a fintech in situation as, for example, in Kenya, they could serve those segments that are typically unbanked. Yes, right. And therefore, if you have a low GDP per capita, it is there where fintech should be more developed. No? This is the rationale for this question. But of course, when you control for the financial development, when you control for country characteristics, when you control for regulation, when you control for everything properly, GDP is basically economic activity, so it captures demand. So this is the rationale. So when there is more demand, you have more requests for credit, and therefore small and medium enterprise ask for more credit. Other things being equal, of course. Okay. Now I wanted to talk to you about sandboxes because I think that could be useful to understand what they are and how much important they could become, especially in the case of innovation and digital economy. So first of all, what is a sandbox? So it is a control environment supervised by a regulatory authority, within which existing regulations are relaxed or removed to allow business to more frequently experiment with new products and services. So it means that firms are controlled in a way by regulation to check what happened to products if some product and services, if regulation is changed. No? So it's a sort of it's an experiment that is done. So this is very important for fintech, but the evidence of their effect so far is quite scarce. So let me just tell you the results of a new paper that actually will be launched on the BIS website on Monday, if you're interested. So this paper explored the link between technology and regulation. In particular, we analyzed the effect of regulatory sandboxes on fintech funding. So the question we like to answer are two. So does entry into a sandbox, the entry of a fintech into a sandbox help startup to raise funds? And what are the mechanisms, and more importantly, what are the implications? So we know that policymakers around the globe are adopting regulatory sandboxes as a tool to spur innovation in the financial sector in a controlled way. There is here a clear trade-off that regulators need to consider. So on the one hand, new innovation could have a positive effect to enhance competition in the financial sector. That is, they can bring efficiency gains, more choice for consumers, and enhance financial inclusion. All good things. But also, in the spirit also of these course on systemic risk, there could be new challenges for financial stability and consumer protection. So in response to this trade-off of how to use innovation to supply new services, policymakers around the globe are creating these regulatory sandboxes to foster innovation in the financial sector while keeping alert to emerging risks. So they study the product in a controlled environment, and then after they understand what's going on, they release the FinTech to operate more on the whole market. So what are the benefits for the regulators? This is very helpful to identify the risk ex ante and facilitate information sharing with the startup. For the startup, these reduce regulatory uncertainty and time to market and improve access to finance, and this is what we want to prove. And in general, these sandboxes have been already adopted in over 50 countries. In our study, we focused on the UK's Financial Conduct Authority that started the first regulatory sandbox in 2015. So the question we would like to answer in this study is whether the entry into an FCA sandbox helps startup to raise funds. So we collect the data for the period 2014-2019, and our sample covers FinTech that joined the FCA sandboxes, that are the treated firms, as well as of a large group of comparable control firms. And the main results of the paper are just for you summarizing this slide. So the left hand panel in this slide provides non-parametric evidence that firms raise more capital upon entering the sandbox. So the horizontal axis plots the time dimension. A value of 0 denotes the date at which firms enter the sandbox, and the axis range from 8 quarters before to 12 quarters after the sandbox entry. On the vertical axis shows that the total funding raised per quarter in red, that is the left axis, as well as the cumulative funding raised in black, that is in blue, that is the right axis. The amount of capital raised increases sharply around time 0 when firms enter the sandbox. The increase in capital raise is particularly pronounced in the first year upon entry and peters out after 8 quarters. The right-hand panel plots the effects calculated by means of a more nicer model that controls for possible pre-trends between treated and control groups, and we can see that the effect is statistically significant. So these results are promising, but more has to be done. The jury is still out. To have sandboxes is actually quite costly, and therefore we need to evaluate the net benefit for the society as a whole. This is just preliminary results. I think that more should be done in terms of welfare implication for the society. So let me pass now to the second part of the lecture, that is on the use of non-traditional data for credit scoring. And before to do so, I would like to spend a few words on the DNA of big techs. So as we have seen, a big tech business model rests on enabling direct interaction among a large number of users. We can have e-commerce platform, social media, search. So there are concrete examples that we have in mind. So when we think about e-commerce platform, we have in mind Alibaba, Amazon, eBay. Social media, we have in mind Facebook. Search engine, we have in mind Google, Baidu in China. So an essential byproduct of this business is the large stock of user data, which are used as an input to offer a huge range of services that exploit this natural network effect, generating further user activity. So, for example, payment service activities generate a lot of data. The e-commerce platform understand if I am a small vendor, the input I receive, to whom I sell my products. Then this creates also network externalities to be fully understood, because the platform can understand what is my network or client, and also the supplier of the good, and the interaction among user members. And also in some cases you have also peer review, because if I am in an e-commerce platform, there is a service through which my clients, they can peer review me, and this peer review is extremely helpful for the big tech company to have a credit scoring. If I perform very well, I sell good products, everybody's happy about me, they understand I am in a good network, the firms which sell me the input are very good firms, and then I sell to a very diversified set of clients my products. This gives me a very good credit scoring, and therefore I can get also other services, financial services. So this means that this will provide new data, because I have new activity, and this will full again this data network activities feedback loop. So let me explain, in a very simplified way. So it's a data analytics, network externalities, and these interwoven activities, the DNA, constitute the key feature of a big tech business model. So these three elements reinforce each other. So the DNA concept is very important. It will help us to understand the big tech in two ways. It can help us to make a distinction between the bank business model and big tech business model along these three dimensions. So why, for example, banks are different? They have data, they have a network, they have activities, but the data are organized differently. They organize pretty much in silos, while the big tech, they organize the data directly for the user to exploit this feedback loop. The network is different because some of the firms that are in the e-commerce platform are perfectly integrated in the platform. So it is their world. While for the bank, yes, I can have a current account with the bank, but then my clients, they can have another current account, and they don't know, if not just seeing the activity on my current account, what is the way I obtain revenues and my costs, because the banking world is not perfectly integrated. And the activities, it is more limited for banks, because while the big tech, they have plenty of activities, and therefore, as a vendor, I can give them a lot of information with respect to what I do in the daily work with my clients and with the firms that I receive the input from. A bank has more limited activities because it is focused on financial services. So this is it is important that we remind this DNA, because it is at the center of what is currently going on. So let me show you a business case. A business case of so now we started with some discussion about China. Now we go in Latin America, in Argentina, and these are data from a big tech firm that is called Mercado Libre. Mercado Libre is an e-commerce platform. So we know that in general, most small and medium enterprise in China, India, and Latin America, they don't meet the minimum requirement to complete a loan application, especially since they cannot provide audited financial statement and may lack of other formal types of documentation. So this does not allow them to be rated by a typical credit bureau system. Big tech firms are able to overcome this limitation by exploiting the information provided by their core business, such as e-commerce or social media, as we have seen, or search in case of Google, with no need for additional documentation from merchants. So basically, they don't need a financial statement. They know the merchant directly into the platform, or they know who we are directly by the use of the social media, or because of the use of search engine. So while both the internal rating and the credit bureau rating are continuous variable, so between, let's say, 0 and 1000, they can be segmented into different risk group, considering this additional information, the the big tech company has. So in this case, Mercado Libre. So imagine that, but this is also what happens because we talk to them. The internal rating of Mercado Libre has 5 buckets, and we can unpackage the credit bureau that is based on different set of information that is characterized by low risk, medium risk, and high risk. While we have 5 buckets for the low risk, 5 buckets for the medium risk, and 5 buckets for the high risk. For a given bureau rating, let's say low risk, the expected loss rate is strictly monotonic with the internal rating, no, of Mercado Libre, no. So it's ABCD. You can see that is monotonic, no, in the various categories. So the pattern of the dots show that the internal rating order expected loss in a way that we can consider proper. Conversely, given an internal rating, let's say C, D, or E, the loss rate is not strictly monotonic with the bank bureau risk. For example, the dot associated with internal rating D, here, this is higher than this, and then this is higher. So it's a sort of a V, no? So this is just telling you that the information that are obtained by Mercado Libre help to unpackage the risk of certain clients in a way that is different with respect to the credit bureau. So moreover, the internal rating has a broader range, covering losses. This is expected losses, no, from 0 to 10%. No, this is around 10.2, no. While the bureau rating range from 0.7, no, to 2.8. So most importantly, by using its proprietary scoring model, Mercado Libre is able to serve the profile assessed by high risk. No, this is high risk. Using the credit bureau, they would never been served. But in this case, you can see that that are considered as high risk because they don't have the necessary information. They are considered as yes, risky, of course, on average, but still there is, for example, the A category in the high risk as a level of risk that is significantly lower than these 2 classes here. So here the size of the dots is proportional to the share of the firms in the rating distribution. Is that 30% of the portfolio originated by Mercado Libre would fall into the high risk cluster. So banks use a mix of credit bureau information and soft information from loan officers, but in general would not lend to these borrowers in Argentina. So these simple statistics indicate that the internal rating system of Mercado Libre is more granular than a traditional credit bureau and allows the firm to serve vendors that would be otherwise be excluded from the provision of credit. However, it remains to be verified if an internal rating system based on machine learning techniques and data obtained from the e-commerce platform can outperform ex post the more traditional model in predicting default over in the case of a shock. So we did some work also on this.
Leonardo?
And these slides, yes?
There is one clarifying question about the big tech credit statistics in general. The question is whether these statistics include also loans by subsidiaries. For example, Alibaba has an online-only bank called My Bank, which is licensed by the regulator.
All these loans are provided by My Bank. So the Ant Group has a bank that is called My Bank. You can say it is a bank. Well, it is a bank with no deposits. So I'll tell you the story. So because this is also interesting because of the IPO on the Ant Group that is actually currently evaluated because it has not taken place. So Ant Group has a bank that's called My Bank. And the loans are supplied via My Bank, but My Bank is the financial side of the Ant Group. That it is not a regular bank because first of all it has no deposits, because the Ant Group, let's say, my bank asked permission to be a virtual bank, but the PBOC has a very conventional view of banks. So a bank can have deposits only if they have branches. So they don't have deposit; they just have liquidity from the activity of the group, and then they cooperate with the banks, because the banks, they want to enter into business with my bank. They can provide some funding, but my bank is the bank that is the financial institution that provides the loan to the vendor. So when I say that the Alibaba, the Alibaba Group provides a loan to the bank, it does this via my bank. So it is not a matter of subsidiary. It is the arm part of the group that provides the loan. So then there are other forms, but mostly is my bank. And for example, for Tencent, it is WeBank. So it's a different bank. But these are not banks, because they don't have deposits. So are basically they can enter into the market for interbank loan, but they're not. This form of credit is provided via the credit scoring obtained at the group level using the information on the platform. So I don't know if it is clear now. Okay, so I'll move on. So this is on the different performance of models for comparing the machine learning model of and big data that use the credit score by Mercado Libre, that is the blue line, with the two very simple model, logistic model, that the red line is the one that use only bureau score, and the yellow line is that use bureau score and typical borrower characteristics. So it is not a fair competition, because the bank has also a lot of soft information, but the yellow and the red mimic a little bit what a bank with a limited use of the soft information does. And this graph plot the ROC curve, that is the area under the receiver operating characteristic, the ROC curve, for these three different models. So as we know, the ROC curve is created by plotting the true positive rate against the false positive rate at various threshold setting, and the area under the ROC curve could range from the 50%. The 50% is the 45-degree line that corresponds just to toss the coin, to a 100% area, that is all this area here, and the bigger is this area, the better is the prediction. So the red line is the logistic model with only bureau score. The yellow line is logistic model with the bureau score and the borrower specific characteristics. The blue line is the machine learning big data model by Mercado Libre. The predictive power rises substantially for the model that use a machine learning technique applied to the big data and the e-commerce platform. The big question here is, this is too good to be true. I mean, just and I would say that this is promising, but it is not. We're not to trust these results 100%, even if I have developed them, because these results are taken in normal times. So the big question is now, what happens in the case of a structural shock, when there is really a shock that could jeopardize the possibility of Mercado Libre to roll over the credit? What happens? Indeed, we did some small work on this using the data. So that now from Argentina we come back to China. In a paper with the Peking University, we have analyzed the impact of a regulatory change in China. You will probably remember when I show you the graph on the FinTech, that there was a huge regulatory change in China that basically determine a lot of peer-to-peer platform to exit the market, And this is This is the line reports exactly this change. So the impact of the regulatory change was to reduce the loan supply, especially to the riskier borrower. As you can see from this left-hand graph on this slide, the pace of growth in the total credit, this is total credit, in the Chinese economy fell by 4 percentage points in less than 1 year after the regulatory change. There was a tightening on platform, basically. Moreover, the sudden freeze on the rolling over of credit, of course, determined a lot of defaults in among the risky borrower and the small and medium enterprise. So in the graph, this graph on the right-hand side, we use the loan repayment records to calculate the discriminatory power of 3 models in every month. And this is always the area under the ROC curve. But for 3 models, similarly to before, we have the FinTech credit score, the red. The traditional information is a logit with traditional information for a bank, and a logit with all the information, also non-traditional. So we did a sort of a North race. So let us imagine that a bank has all the information a FinTech has. So, for example, application on the mobile phone to understand how many calls you do, the length, the payment, and so on. And you can see that in normal times, the difference between traditional information only and these 2 lines. But what happened after the shock? The model
Leonardo?
with the machine.
Sorry
Yes.
to interrupt you. You were quickly away and now we have lost your screen. Maybe can you reshare your screen? Maybe it's only me, Angelo. Do you still see his screen?
Yeah, I have the same problem. Just
Okay.
sharing the screen.
Yeah.
Yes, good.
And maybe if you at the end of the slide there was just one question about which machine learning models you used and whether you have tested different models. Maybe you can also add this to this. Thanks.
Okay. So first of all, can you see the screen?
Yes.
Okay. So did you see this screen, this slide?
Yeah, we just lost you 10 seconds ago, so we have seen everything. Yeah.
Okay, fine. So you basically the performance here is substantially better for the FinTech credit score with respect to the traditional model after the shock, and this probably reflects the non-linearity of the machine learning approach. So there is so now I didn't so what in this paper to answer the question, I didn't have access to the confidential data. I did have access to the machine learning credit score. So basically, then I could have access directly to the outcome, but I couldn't get information to compare different kind of machine learning, because the FinTech company, of course, they didn't want to show their internal cooking. They told me about the characteristic of the machine learning. It was supervised. They have selected not actually a huge number of data, so they didn't use thousands of series, but they use I think at the end something like 100. So this is very important information. So and they use a random forest, but I was not able, unfortunately, to ask them more information about what is the best machine learning model they use. So in this case, I can just tell you ex post, because this is ex post, because it's we analyze the credit we analyzed, they were taken here, and then we analyze ex post what happened to the we analyze the credit score here, and then
also with the credit score that we obtained from these three different models. And then we had a look at what happened ex post. So this was a proper horse race, but we couldn't enter into the analysis of what kind of machine learning. So the vertical line represents the date of the regulatory shock, and so interestingly, it seems that prior to the shock, it is the richness of data that counts, because the machine learning and the logic, they perform the same. After the shock, the machine learning, the nonlinearity is able to get a little bit more info. So again, these results are encouraging, but the many default of fintech companies in China in the last year call for a more complete assessment. There are a lot of platforms that just defaulted. So, and then another question I have in mind is fintech credit different from big tech credit? For example, big tech credit, due to the presence of this network, could be more relationship type. So the vendor is into the sort of ecosystem. The big tech has also an incentive to keep the relationship, while the fintech credit is a platform type. So it's more of a transactional type. So I think that also in terms of protection of the vendors is very different. So big tech credit is very different from fintech credit. But a complete assessment need a full business and the financial cycle. So let me move on the third part of the talk, that is on the effect on credit, procyclicality, and the financial accelerator mechanism. Alex, how much time do I have?
So we have two outstanding general questions, and I would just ask the students to hand in their remaining open questions, and I would say you could go on for another 5, maximum 10 minutes, and then we will handle the questions, if that's okay.
Okay, not too much. Okay, let me go a little bit more quickly. So I would like to talk to you of the results of a new study on how innovation and the use of big data change the financial intermediation process. And here we use a unique database from China, from Ant Group, to study how the use of data could replace the use of collateral. So in particular, we aim to answer two questions. So the first one is on the procyclicality of big tech credit and differences, if any, with the bank credit. The second one is how the entry of big tech in finance could change the functioning of the monetary transmission mechanism. So the analysis shows that big tech firms use this massive amount of data collected by these many sources, payment, e-commerce, social media, to assess the firm's creditworthiness in a way that reduce the relevance of collateral in solving asymmetric information problem. So, of course, the replacing of collateral with the data is particularly important for small and medium enterprise that in many cases they don't have, as I said, financial statement and are therefore particularly opaque. So in this paper, we use this information on a random sample of more than 2 million Chinese firms that receive credit from the Ant Group and the traditional Chinese bank, and we are able to compare three different types of credit. So it's a big tech credit that is typically short-term, as I said to Angelo, secure bank credit, and we can think here about mortgages, and unsecured bank credit, and these are mostly short-term credit lines. In particular, we compare how credit from a big tech firm and traditional bank lending correlate with the local economic activity, house price, and firm characteristics. So let me show just the results on this one slide. And this slide indicates the elasticity between the different credit types with respect to house price and local GDP. We have big tech credit on the left-hand side, secure bank credit in the middle, these are mortgages, and unsecured bank credit on the right-hand side, typically credit lines that have a contractual form that is very similar to the big tech credit. So the elasticity of these different form of credit with respect to the house price is reported in red, while the elasticity with respect to the local GDP condition is reported in blue. So if you look at the red bar, the elasticity of big tech credit with respect to house price is 0.06, while that of unsecured bank credit is twice as high, 0.21, and that of secure bank credit is 10 times higher, 0.58, than that of big tech credit, Well, this is not surprising because secure bank credit includes mortgages that are typically collateralized. Turning to the reaction of credit to the real business cycle, the elasticity of unsecured bank credit with respect to GDP at the city level is more than 3 times, it is 0.15, than that of big tech credit, that is 0.04. So the latter is not zero because some of the ungrouped clients are also offline, and their business depends on local condition. So it means that if you have a shop, of course, and or a restaurant, and you are a vendor, also you also sell online, but still there are some clients that arrive into your shop, and this depends on local condition. So these results are relevant for policy because we find that the big tech credit is less procyclical than bank credit, and this reduces the overall effectiveness of the financial accelerator mechanism. So, and of course, this has implication for the monetary transmission mechanism. So, however, also in this case, other questions arise because we'll discuss them later, no? So, for example, one is if we can replicate some elements of this Chinese model for Europe, for example, given the different privacy rule. So let me pass now to the last part of my lecture that covers the implication in terms of public policy. So we know that public policy should maximize welfare. So this can be reached maximizing the overall benefit of FinTech, minimizing its cost. And to do this, public policy typically sets some intermediate objective. No? To reach this objective is not so simple in the presence of digital innovation. This because FinTech may give rise to complex trade-off between 3 categories of policy goals that are synthesized in this slide. So we have on one side is financial stability and market integrity. Then you have efficiency and competition, and then you have data privacy and consumer protection. And these trade-offs can be represented as a sort of a triangle. So let me start first with the competition financial stability nexus that is represented by the red arrow in the slide. So regulators in the past have long debated on the relationship between competition and financial stability. There are particular 2 lines of thoughts on the competition stability nexus. An initial line of thought emphasized that greater competition was not always optimal or conducive to financial stability because more competition reduced bank profit and their overall franchise value. This was an idea, is very, very old-fashioned, but at the end, if you have only one bank and it is it has monopoly on a market, of course, it is super stable, no? But second, as a more recent school of thought argues that greater market entry in the financial sector is desirable because this fosters competition and reduce incumbents' market power and also produce more efficiency, no? So, however, the FinTech and Big Tech entry into finance may change these paradigms completely. So, in particular, due to this data network activity feedback loop, the relationship between market entry and competition may change dramatically. So big tech, with control over key digital platform in e-commerce, search or social media, may create situation of digital dominance. So such control may also generate conflicts of interest when the big tech sell on their platform products of their competitor, for example, banks. For example, in some countries, the big tech sell the products of the bank. But if they have their own products, of course, they will tend to sell better their own products than the one of the banks. So in India, for example, the main e-commerce platforms are prohibited from selling products supplied by affiliated companies or on their website, including financial products. Just to avoid the conflicts of interest. So just as an example of how entry in the payment market by big tech could affect competition, this slide shows the merger and acquisition activity by digital platform, so big tech and the card network. It divides forms of vertical integration in red and horizontal form of integration in blue. The slide shows the deals between 2014 to 2020, and you can see that there have been many acquisitions. This could reflect that big tech and other dominant players in the market buy the best new fintech companies. So these new companies could be acquired before they get theory. How much time do I have so far?
So We just lost you again for a couple of seconds, Leonardo. I would say you have another 3 or 4 minutes. So
Okay.
maybe if you could reshare your slides quickly again, and then. So we have 2 open questions now, which should be sufficient to in 5 minutes, or you have another 4 minutes, let's say.
Okay. So you can see the slide, right?
Yes. Yes.
Okay, let me pass now to a new dimension that we need to explore, the new competition privacy nexus. So this is represented by the blue segment in the slide. So while competition and more efficient solution may often benefit consumers, there are also tension, particularly around the data privacy. So in the absence of a privacy concern, so wide access to the data would in principle be efficient. So one special aspect of the use of big data as an input to production is that the data can be used many times and by any number of firms simultaneously without being depleted. So this is called non-rivalry. So yet the sharing of the data can harm individuals. For example, open access to personal data can allow for identity theft, reputational damage, and the manipulation of behavioral bias to sell consumer products that are not in their own interest. To name only a few examples. And then there is a particular risk is the monopolistic use of the data by the big tech. And moreover, algorithms used to process the data may also develop some bias, leading to unethical discrimination. So let me just to position on the efficiency privacy trade-off. So we have this trade-off. It matters of the preference of the society, and depends on where we want to go. For example, in this recent study that we have conducted here at the BIS using a survey from Ernst & Young, we find that the men are more likely to use fintech product service than women, and that this pattern holds in almost every country, actually except for Peru and India, and all the subcategories: payment, investment, borrowing, insurance. So to position is really is a choice. So and just very quickly, there is also a third type of trade-off to investigate, that is between privacy and stability. And this trade-off between privacy, that is consumer protection more generally, and financial stability, the market integrity, on the other, is represented by this green segment in the slide. So in general, theory shows that data sharing alleviates problems of asymmetric information and therefore could be beneficial for financial stability. So in the credit market, for example, there is ample evidence that the more data can improve stability. So credit registry, for example, can reduce information asymmetry between lender and borrowers. But there is also a downside of this that is limits to privacy. In a world of digital innovation, in which a much wider range of data is available for screening, there may be an even higher premium on giving the individual such access and rights. One important area on payments is reducing illicit activity and preserving market integrity. This can have costs in terms of privacy and serving the customer. One example we have in mind is the anti-money laundering and combating the financing of terrorist rules. But this practice requires an exchange of very detailed information on all parts involved in the transaction. So this could reveal the habits and preferences of clients. So this is the last slide with the main takeaways. I will discuss them together with some questions if we have time. So I'm happy to bring a question, if any, at this point.
Okay, great. So thank you. So we have 2 questions currently. The first one is, wouldn't it, from a financial stability point of view, be important that fin and big techs fall under the exact same regulations as banks once they engage in credit lending? After all, maturity and liquidity transformation are crucial functions within an economy and should be closely monitored and regulated.
No, I agree. This is the principle: same activity, same regulation. So the point is that if a big tech behave as a bank, it should be regulated as a bank. The point is that sometimes there are rules only for intermediaries that they don't have deposit, no? So, for example, the big tech, if they don't have deposit, they cannot be considered as a bank. and therefore they fall into a different category. No, there are other financial intermediaries that also factoring companies, that the leasing companies. No, they do credit, but they finance themselves via non-deposit, and therefore they have to be treated differently from banks. But I agree 100%. Same activity, same regulation. If they behave as a bank, they have to be regulated as a bank. And the reason they don't venture too much into finance, I guess, that is because they don't want to be regulated.
Thank you. So Sophie writes, if I understood well, these big techs can enter the credit market directly through a branch of their company. But can they enter the credit market also indirectly through partnerships with financial institutions, or do they do this?
Yes, they can. My bank can provide directly credit to the vendors into the platform. But of course, the funding on the funding side, my bank has limits, and therefore it's very convenient for my bank to join venture with the bank to get additional funding and together to finance the credit. So for the bank, there is a fruitful investment as far as the credit scoring of my bank is successful. For my bank, they can lever up their scale and they can get more credit and make more profit. So yes, they can do directly. They can also create a bank. So a big tech can create a bank. A bank, they can have deposit and so on, but then the big tech has to be regulated as a bank. And therefore, for example, one important element, a bank cannot sell products on the e-commerce platform. So have you ever seen a bank selling products, I don't know, glasses, TV screen? It is not possible. There is a separation between commerce and financial provision of financial services. But the big tech, for good reason, they don't want to become a bank because they want to keep the good profit in the activities they do. So there is a blurred situation here, and indeed sometimes it is confusing actually.
Okay, last question from the audience. It's a more general question. Do you have any thoughts on Jack Ma's recent comments that the Basel regulations are not applicable for fast-growing markets such as China?
No, Jack Ma point is based. So I want to really, this is my personal view, and reflects also the interaction I have with the Ant group. But so Jack Ma point is he has a point. Maybe that he expresses point not in a nice way for the regulators, but the point is exactly the one that we have seen in my slides. So I have a paper. It's called Data versus Collateral that tells that the use of the data could replace the use of collateral. So if I have if I bank or a big tech, I have a lot of data on a firm, I can provide credit in a way that is safe because I know the firm and I don't need collateral. No, I don't need collateral. If I know the firm and I know that it's profitable, I don't need collateral. And therefore, if I have a lot of data rather than collateral, my credit scoring is good. So in the Basel III, I am not to speak too loud because the Basel III is on the other floor. In the Basel III, the risk weights are very different if a loan has collateral or not. If a loan has collateral, the risk weight is very, very low. If the loan has no collateral, the risk weight is higher, no? But it is because Basel III was conceived in a period in which this business model on the data was not in place. So the point of Jack Ma is that these rules should be adapted, no? Should be adapted. If there is a trust on the use of credit scoring using the data, the risk weights should be in a way adapted to this new business model. So this was his main idea that I think is good. I mean, is something that the Basel Committee should consider. No, we are open to a change into the financial intermediation process, and for good reason we did these studies, together with Ant Group. But yeah, so this is the nice. But then, of course, he said something it was.
So now I think we lost him again. Now you're back. So
But
we lost you. We lost you for a couple of seconds, but I think we got the answer of your question.
Yeah. Okay.
That was a very interesting point that you made now, because especially now in this framework where we are, where there is a safe asset scarcity, right? I think it's a powerful idea that data could somehow replace collateral in a framework where there is scarcity of assets that can serve as a collateral. It also goes in the direction of, this idea that from Gorton and Holstrom, that there are some loans that are more information sensitive, and then they need a collateral to provide more protection to the lender. So then it's really in line with your reasoning, right? If you have information and you process this information in a sensitive way, you can reduce the risk, the counterparty risk, and symmetric information in general.
No, but the Basel III, is just has to be regulation. Should be adapted to the business model. No, the rules are not written completely in the stone; they can be modified. If there is a business model that proved to be successful using the data, it could be changed. No, but the problem is that to do this, we really need more information and more tests over a full cycle. No, even to calibrate regulation, need to understand what happened, over the full cycle. And now with COVID-19 shock, this will be, it's difficult to find something positive out of the COVID-19 pandemic, but it is an experiment. We can see the resilience of a certain business model and see if Jack Ma is right, or if Jack Ma maybe is half right or is not right. I mean, it's just
very true. Okay, so Alex, Leonardo, if there are not more questions, or I don't think.
So there is one question.
Okay.
I mean, maybe really quickly as the last one, and I think you can answer this quickly, Leonardo. The question is whether the BIS is researching the field of security tokenization offerings.
Yes.
Okay, that was brief. Perfect.
Okay.
Good. Angelo, do you want to maybe say some concluding remarks? Or
thank you very much, Leonardo. Very insightful. I also like it a lot, your way to interconnect stability, efficiency, competition, and privacy, consumer protection from an angle of FinTech. It's very interesting. So then I think we can conclude here. Thank you very much to everybody for joining the webinar, and there will be the final one tomorrow. I hope you can make it. And bye-bye.
My great pleasure. Stay safe.
Thank you, Leonardo. Bye-bye.
Bye.